What's up, you guys? Mighty Mike here. I'm excited to bring you guys an episode, very special episode once a month. If you guys have not noticed, we've been doing these Mighty Roundtables with my friend Shannon Robnett. And today we have a very special guest, so don't go anywhere. You are listening
to the Mighty Mike Show.
Mighty Mike Show.
Real estate, it's not for the faint-hearted.
Most people are doing it for the safety and security to have some form of lifestyle that they don't have now.
I would literally just go around and start knocking on doors or cold calling Zillow for sale by owners.
Just take action.
You don't need to do any sales. If you are just adding value and providing value to people, it will come to you.
Your income, your life is all going to come back to the connections that you have.
And you are listening to the Mighty Mike Show.
What's up, you guys? Welcome, Shannon. Welcome, Larry.
Good to be back, Mike.
Hey, thanks for having me.
Hey, so Shannon, maybe you want to dive in and introduce Larry. I got a bunch of stuff up here on him, but I am so excited to dive into that big brain of his.
Well, the funny thing is, Mike, as you know, when people go out and they start getting involved in real estate or start making money, they get an accountant, they get a realtor, they get a mortgage guy, they get all these people. But they never think to create a strategy around why they're doing what they're doing in a tax advantage way. They think, and a lot of people think this, I even thought this for a long time, that by having an accountant, you had somebody that thought about your taxes. But I'm going to tell you, an accountant puts stuff in boxes, okay? And most people go see their accountant in February. It's too late. And I have spent a lot of time, money, and effort reading books, going to seminars, doing things, and I found Larry. And Larry is a tax strategist. And so what Larry and I do is we sit around and we figure out how to get that fat, ugly Uncle Sam out of our deals so that we don't have to pay him 37% for doing nothing. And over the years, I have watched what Larry and I have been able to put together and save people thousands of dollars on all of their real estate strategies that allows them to invest quicker and get to that retirement finish line that much faster. Larry's got a ton of experience, so I'll let him tell you a little bit more, but we have done some amazing things to help streamline people's investment strategy and get to that finish line quicker.
So Larry, let's dive in, man. Tell us a little bit about yourself.
Yeah, well, Shannon just gave the $1 million intro right there. I need to record that and play that before every intro. As he alluded to, I'm a tax strategist, and I use that word specifically because it denotes proactive planning as opposed to the reactive side. So our industry is fairly guilty of, hey, bring me your stuff. Let me tell you all the things that you should have, would have, could have done. And we'll see you again next year so I can repeat that same process. We've kind of taken that concept and flipped it on its head. And it's like, well, how about we sit down and have a conversation today, right now, February 2022, to talk about what this year is going to look like, what strategies we want to put in place before the end of the year so that when December rolls around, we have a very clear idea of what our tax bill is going to be. And we know that we've done everything possible to get that number as low as it can be. And also a keen eye towards the future. What does next year look like? When are we planning to do transactions? How do we pivot given some of the tax law changes that are upon us? And so we're strategists. We're always thinking about how do we pull this thing together in the most tax efficient way.
I love it. First thing I want to say, and this is something that I've been thinking ever since I saw that you were going to come on the roundtable. I was like, I got to ask him because I get investors all the time asking me, what am I going to do with the $200,000 that I'm going to have in equity once I sell the house, Mike? I say, well, 1031 it into a new property. But there's actually a lot of other things you can do, right?
Yeah, absolutely. Now, the 1031 exchange becomes a default for most folks. And it's a good strategy to use initially if you can fit within the ID dates and get the transaction done in time. Right. But especially in today's market, it may be kind of tough to find something that you really like as an investor. And so we've seen a lot of people do 1031s just for the sake of doing them, and they're not necessarily rolling into good investments on that next go round. So what are the other exit options that you have? Just a few that come to the top of mind. You can look at what's called a deferred sales trust. You can look at different type of charitable trusts. You can look at a number of different exit vehicles that allow you to either defer the capital gain or completely get rid of the capital gain, i.e. opportunity zones or opportunity funds at some point down the line as well.
Well, then the other thing too, Larry, remember what we did with Airport Plaza, where we took an investment, we did a bonus depreciation, where we took accelerated depreciation. And if you strategize that, where you're doing some investments here, where you're investing in new things, you're doing a bonus depreciation, and then you're selling other things, you're able to offset a lot of that gain with how you strategize your taxes as you go along. Instead of, Mike, how many times do people come to you and go, oh, by the way, now that we have this under contract, I want to do a 1031, and you're scrambling because you're trying to find a replacement property and they just put you under the gun, right? It's the same thing with Larry, right? If you're having those conversations early and often, you know of ways that you can do that and create those kinds of things where you can create alternatives. I mean, oil and gas is another great investment that provides bonus depreciation. I did it this year like I do every year. I bought another airplane that I depreciated out 100% of the airplane. Pissed my wife off. I got a new set of wings, right? But we did that as a tax strategy because we sold stuff, right? And so there's all ways. Larry's got a lot of that stuff in that big brain of his.
The key there, Shannon, is basically you keep the dollars rolling. The moment you want to take the money and run, well, all of a sudden you got a tax problem to deal with. But if you're constantly reinvesting, there are strategies available to you.
Right. And the other thing that a lot of people don't know, Mike, is refinancing. That's not a sale. So you don't have, it's not the best news for realtors, but if you do a refinance, you're able to harvest some of that equity, go out and purchase another property. Now you have 2 properties. Now you've got 4, 8, that kind of number. And you're able to grow your portfolio without ever recognizing those gains of actually having to sell.
Mm-hmm. Yeah, when I found out that that you buy a property and that whatever equity you realize, when I found out that equity was not taxable until you sold that asset, and you could just keep that, like literally you could take that equity. I wouldn't recommend this, but if you wanted to go buy like a really nice car, you wanted to go buy these things, you could buy it on that equity and not really have to pay the tax on it, right? You pay the tax for the thing you purchase, but being able to roll it into future investments is obviously the smart thing to do, right?
Yep.
Well, and then take that really nice car and make it a Toro car and make it a write-off, Mike. I mean, come on.
Or tokenize it.
Right? There's so many things, but again, most people make the purchase and then turn around to their accountant and go, save me from what I just did, instead of having the foreground conversation that says, hey, this is what I think. Oh yeah, we can do that, right?
So maybe we should talk about that for a second, because I go through so I've a bunch of different businesses and I want to somewhat keep it focused on real estate, right? But at the same time, in other businesses, I always feel like when you're talking to an accountant, it usually is after the fact. And it's like, why didn't you tell me that I could have done this or that? What do you think about that, Larry? Like, I know that's just people, they didn't prepare, but are there actual things that you would have said, hey, you should do this? Or do you just have too many clients to do that? I'm just curious what your take is on that.
No. What typically happens, and it just depends on what segment they're operating out of. And so when you have an accountant, they're usually focused on the numbers and the books. And so they're busy making sure the financials for the company look great. That doesn't necessarily mean they have an eye towards the tax implications. Well, then you say, well, what the heck is my CPA doing? And CPAs step into that space. And there are some that are excellent planners, but most have an eye towards preparing the tax returns, basically memorializing what the accountant gave them. And so they're missing that gap in between of, hold on, pause, before we execute anything, let's put the strategy around it. And that's where we step in. And it's like, before you engage in a transaction, let's sit down and talk about it. At the top of the year, let's have a meeting for what you expect the rest of this year to look like. So that way we've got contingencies in place, assuming we hit these markers.
Mike, Larry says memorialize it. I call it a post-mortem because it's already cooked. It's already dead. You already owe it. That goose has been in the oven for a couple of hours. It is over. But like Larry said, I meet with him in February, and then we got together again in November. We squared up the transactions. We knew what we were doing. And I got told by my guy that I got to go spend some more money and get some more depreciable assets because I needed to get out of some of this income that I've been making. But if people will spend that kind of time, just a couple hours, you've already got your taxes done. It showed what you did bad last year. talk to somebody that will show you what you can do this year if everything stays the same or if things are changing, how you're going to make that work for next year, and then come back in November and make sure that you're on track, because maybe you had a way better year than you thought, or maybe you didn't quite have as good a year as you thought, and there's no need to do some of these things. But there's also ways to look at it and go, hey, this is what we paid last year, but can we hurry up and do some things this year that will allow us to go backwards? Can we go backwards, Larry? Can we go backwards and get money from last year brought forward?
Well, if you do things appropriately, right, and you have enough of a loss, there are possibilities where you can go back up to 3 years to recapture some of the additional taxes that you paid.
Right?
Now,
Can you believe that?
That's
I can
structure-
go get money back from the IRS.
Send Uncle Sam a bill. Hey, that money I sent you, I'm gonna need some of that back.
need some of that back.
Just let him keep it, right? Say you owe me.
Yeah. Well, the other thing is, First Bank, Uncle Sam, we see how they like to spend it. But, and there again, Mike, so many people take the time, they plan what they're going to do with their business, right? They plan their advertising. They plan what their business cards look like. They plan their location. But the biggest expense in your income is up to 37% in federal alone, and nobody plans for it. 80% of people don't plan for it, And yet there's absolutely no reason to have to pay taxes. One of the things that I heard a gentleman say is that people think of the tax code as a penal code, and it's not. It's the rewards code. It tells you, the IRS tells you, Mike, right now, we both know, you and I both know that we're about 7 to 9 million housing units in America short, right? We're having a huge housing shortage. We're having supply chain issues everywhere, right? And the IRS is part of the federal government. The federal government wants to solve the housing problem, so they're giving developers like me and investors like you tax benefits for owning these and turning these into rentals, right? Mm-hmm. Because there's not a lot of tax advantages with home ownership if it's your primary residence, right, Larry? What can I get if I own the home? If I live in my own home and it's not a rental, what can I get for deductions?
Oh, congratulations. You can take mortgage interest and property tax, but even that's capped at $10K with the property tax.
So I get a write-off the 3% interest I'm paying? Oh, yay, right?
Yeah.
So, but if I have this house as an investment, and let's just say it's the same $300,000 house, what can I get from that standpoint if I were to do some of the things that you have told people to do?
Well, first of all, you've got tax efficient income coming in with the rental dollars that you're going to have flowing in. Secondly, you've got the power of depreciation, which helps offset that tax, but can also help offset income in some of the other places as well. And then you can accelerate that depreciation, meaning up to 20, maybe 30% of that purchase, that price right away can be taken as a deduction in year one. And so essentially, as you mentioned, it's a reward system. They are rewarding you for contributing to society by building housing for the people.
So to recap, Larry, what I thought I heard you say is that if I own the house and I live there, I might get $10,000 worth of write-offs, which in a 37% tax bracket's less than $4,000 to me.
Yep.
Is that about right?
Yep.
But if that same $300,000 house, I'm able to take 30% of that. That means I'm writing off $100,000 at a 37% tax bracket. Means that Uncle Sam's sending me a check for $37,000.
Check the box.
I think I like rental income, don't you? Oh, and then you talked about rental income because rental income is taxed at a lower tax rate, right?
Well, you've got depreciation that basically wipes out most of the tax impact that comes from the rental income. Oh, and by the way, if you start to add energy efficient improvements, i.e. solar and some of those things, now we've got tax credits rolling in. There are tons of opportunities that flow when you actually own the asset and then use it for business purposes.
Why do you say a tax credit versus tax efficient? What's the difference? What's the difference on a tax credit?
Yeah, so a tax credit is an actual reduction of the amount of tax that you owe. If the IRS sends you a bill and say, "Hey, you owe us $100,000," and you have a credit for $50,000, well, now you owe them $50,000. A deduction is not a dollar for dollar reduction of the actual tax owed. It is a proportionate reduction. So you owe them $100,000, but you've got a $50,000 deduction. That basically only means your tax bill is going to go down by maybe $20,000, $25,000. So that's why tax credits are more powerful than tax deductions.
And then do you have to repay tax credits?
Tax credits don't have to be repaid.
So when you sell the house, that's not part of your 1031. You took a $50,000 tax credit in the scenario we're talking about, and you would take the next $50,000 you were going to send to Uncle Sam and pay for your solar panels, right?
Yep.
And then when you sell the house, you don't have to recapture that like you do with depreciation.
Exactly.
All of a sudden, I want a Prius and a solar panel. Just kidding, not a Prius. I'll take it.
Well, Larry, I got a question. So when you're doing this stuff and you sit down with people, I'm just curious because what a lot of these people that I work with, they don't want to have to pay an accountant a bunch of money and then maybe not get what they're looking for. How does it work for you? Like if somebody wanted to work with you on this, and because we just went through a whole strategy, right? And if I work with a lot of multifamily investors that are going in like 100 units or 200 units, and they're actually running the numbers. They're very good at running their numbers. Mm-hmm. But when it comes to the tax part of it and getting these tax benefits, is there like a consultation or is there a way that, do you work hand in hand? I know you're doing that with Shannon here, but is that something you do like as your business?
Yep. That's a main core of our business. We do tax planning and strategy. And so we have an initial plan that we sit down with all of our clients and go through. It's a very robust questionnaire. And quite frankly, we want to know everything about you. How are you making money? Is it through your business? Is it through your rental? If you've done a mortgage application and you see the stuff that they want to know, we're a close second, right? Because we got to understand exactly how the dollars are flowing into the household. And from there, based on all of that data, we start to formulate a strategy of, hey, if we start to execute these things, or if we restructure your entities in this particular manner, it will result in X amount of savings. And so we essentially pay for ourselves. Whatever fee that you pay us, you're going to save multiple times on top of that, whatever our fee is. And so that way we make sure you're getting a good ROI. And when you're talking with real estate investors, they love ROI, right?
That's a word we all love to hear. Plus the other thing too, I mean, look, this is the thing that I've learned over the years. I go in and I sit down with my accountant, and my accountant's, I always make sure I'm not the first appointment because she's halfway through her cup of coffee. She looks at me and goes, God, Robnett, what do you want to tax evade now, right? I mean, what do you want to get out of now, right? And I start talking about this strategy and this thing that I read, and she's like, yeah, you could do that. And then she starts spitting off Code 27 and, all this other stuff. And I'm like, I think that's what the guy said. But when you get done with Larry actually wrote something in accountant. It's kind of like Chinese, but a little different, but he wrote it all out. So you hand that to your accountant, and they now know all the tax codes that you're talking about. It's not a half-baked idea by some developer out of Idaho. It's actually from somebody that speaks their language, Accountanese, right? Just don't get the number 17. It's no good. No point. But that's the benefit too, because then I don't have to look at it. And there's a lot of things that Larry's come to me with that said, hey, you could do this and you could do that. And I'm like, I didn't know that. I'm gonna make that my own. So it's definitely that at the bottom for sure. But Larry actually does give tax advice. He does give.
He can. He absolutely can.
We're going to have some other people on to tell you how not to pay taxes, but they're going to wear orange jumpsuits, right, Mike?
Yeah, exactly. Good stuff. No, this is great, man. One of the things that I'm always doing as a real estate salesperson is I'm studying, why people make certain decisions and sales and all this kind of stuff, right? And one of the things that I find most interesting is real estate investors. They call it the C personality, and not to go into it too much, but they get really into the numbers. And Shannon's definitely one of those kind of guys. Even though he has a great personality, he's definitely got a mind for this stuff. And I feel like that's kind of what you have to also be like that when you're an accountant, right? And so do you see some similarities with your clients that are maybe someone like me that's more like, just run and gun and like, what are the numbers? What? Okay, let me, get with someone. Do you feel like your client, most of your clients are like that, or do you have a mix of all of them?
I've got a mix of all of them. They fall into one of three bags typically. There's and all of them have this underlying thing. I want to pay less in taxes. That's why they come see us, right? Yes. Then you sit down and you say, okay, well, these are the things we can do. And they look at you and they say, that sounds illegal. No. Great, perfect, no problem. Then you have a second batch that look and say, that sounds okay, but I don't know. I don't quite know if that fits, right? Like, how and why does this actually work? And so then we get into the actual jargon, and then they'll back off and say, okay, do it. And then the last bunch is like, perfect. This makes sense. We know you've got our back. We know what the savings are going to be. This sounds like ROI all day. Let's take it and run with it. And that's typically, I mean, that's usually how it goes. You're going to fall into one of those three categories.
Yeah, and the third category,
fourth category, which was, hey, Larry, we should do this and this. And he's like, hold on. You got to have this and this to go with that, right? I mean, there was, I'm not saying I had all the steps down, but I had most of them,
Listen, Shannon is the anomaly right there. He definitely does come with his ideas. And so here's the thing I want to point out about that, because that's really great in that, they look at us as tax professionals because we're in this space, but that doesn't mean you can't challenge the assumptions, right? Because most accountants are going to think within the black and white side. Either you check the box or you don't. They don't put the strategy together. And so when you have a client like Shannon who says, well, what about this? It kind of forces us to look at it from an entirely different lens and consider, is this actually possible? And can we make it happen, in the most efficient way, obviously, and in the most legal way as well. And there's absolutely nothing wrong with that. You want to have someone who kind of pushes you outside of your comfort zone to think strategically, and that's how you accomplish things.
Well, and I learned a long time ago, if you ask, can I, you're going to get somebody's opinion. Mm-hmm. But if I go to Larry, and Larry, remember the conversation we had about watches?
Yep.
I got a thing for nice watches. Okay. Yep. But paying $30,000 for a watch that's just going to sit part of the time, you're not going to wear it all the time. I went to Larry and I said, Larry, how do I write off $300,000 in watches? Right. Well, if you Google iWatch.com or rent a watch, there are companies out there, Mike, that you can rent a watch. You can rent a $30,000 Yachtmaster. You can rent a Panerai. You can get just about any kind of watch you want for a monthly fee. Well, what do you think the investor is doing when they buy that watch? It's an asset that becomes depreciable year one because it goes into a business. And now you've written off the watch. It becomes worthless at some point down the road. It's useful life. I don't know. What's the useful life on a watch, Larry?
A watch, I believe it's going to be 7 years, 5 or 7 years. One of those two.
Well, 7 years later, that bad boy is worth nothing and it's mine, right? But you create a business around what you want to do. Instead of trying to ask, can I? You need to come to someone like Larry with, I want to. Mm-hmm. How do I? And then Larry goes in, and I love challenging Larry because that's funny, because I've seen him do this a couple of times. He's like, oh, wait a minute. And an hour later, I get this email, and it's not short. And it's all the steps I would have to take. But then I can write off $300,000 worth of watches, which that one my wife's a little bit more excited about because there's a couple of watches she'd like to have too. But when you start to really think about it, Mike, there are ways that you can incorporate so many tax savings into what you're doing that you're virtually in a position where you pay no taxes ever.
So Larry, what is the most common example of this? Because the $30,000 watch, the Bugatti, that Shannon's driving,
right?
What is the most common version of this? We have like let's say a multifamily unit. Let's just say 20 units. You mentioned the cost segregation, basically, like on the first year, right, where you can depreciate all of it for the lifetime of it.
Yeah. So you basically change the useful life of the property. Whenever you're dealing with residential property, whether it's a single family or commercial residential, the IRS says it has a depreciable life of 27 and a half years. That basically means you take the purchase price divided by 27 and a half, and that's the deduction that you can take. Enters the cost segregation study. It basically comes in and says, hold on, we know that there are pieces of this building that will not last 27 and a half years. That's air conditioning, that's windows, that's roofing, all these different components. And so hence the name cost segregation. They segregate those costs, and they change that life from 27 and a half down to either 5, 7, or 15 years. Now, simple math tells you if you got something and you divide it by 27 and a half versus dividing it by 5 gives you a bigger piece of the pie. So already you've got a larger deduction just by way of that. You couple that with the current accelerated depreciation rules that we have right now, that useful life of 5, 7, or 15 years is now depreciable is fully deductible in year one. And again, basic math, if you divide something by one, you've got the whole piece of the pie. And so a good rule of thumb to look at on a cost seg study is generally somewhere around 15% conservatively, 30% a little bit more aggressively, but somewhere in between there, you can accelerate that much of the purchase price right away in year one. That can be a massive deduction. $1 million property, $300,000 deduction, that's powerful.
And as you know, Mike, nobody pays cash for the property. So they put 20% down, they deducted 30%, right? They're already in the money. How do you calculate an ROI if you got all your money back in the tax year prior or
cash on cash return?
Right? So you're buying that property in December, like we did with this office building, bought it in December. The cost seg study comes out. Everybody in April's got their money back, or a lot of it back, just through the strategies that we use, so they don't have to pay the taxes. So now they're ready to reinvest that money because they didn't have to send it to their ugly Uncle Sam. Right?
And then, as we talked about already, energy efficient improvements, there may be some additional energy credits. Depending on what kind of value add you do to this property, there could be tax credits waiting for you.
Yeah.
So let's take it a step further. So guys, let's take it a step further. What were you saying, Shannon?
We're doing that with lighting and all kinds of stuff. Plus, we're also doing a co-working space. So we're putting in co-working where we're writing off all the desks, the telephones, the computers, everything that you want to use this year. We're putting that inside the building. So now we've got another $250,000 worth of instant depreciation year one because it went into play in that business. It's just massive, right?
Yeah.
Massive.
So let's take it a step further. Let's just, because you're saying you're putting all this stuff in the office. What if, because I want to kind of carry this example. You got $1 million building, you got 300,000 from the cost segregation study, then you got the write-offs on the stuff that you put in the building, but giving it more value. So maybe we put on a new Tesla roof with all the solar panels or whatever kind of roof, but solar panels, right? We get the valuation. And Shannon, I know you know this. You get the valuation from $1 million to maybe 1.7, 1.8. And then now how much of that equity, what we were talking about in the beginning, how much of that equity can we now take out and go buy, 100 watches?
Right. Well, there's two ways to look at that. One, you could refinance that, right, and capture that $700,000 in equity that you have, or you could take that lower basis because you took it from $1 million and you depreciated out 300,000. So now you've got a lower basis in it of 700,000. You could do a 1031 into your next building and take all of those proceeds and now buy a $3 million building because you have 30% down or 20% down on a $3 million building and not pay any taxes in that whole scenario. And then do that thing called rinse and repeat and take a $3 million building and make it a $6 million building and roll that again. Still no tax consequences, still enjoying all of this. All of these write downs for yourself. But think about that, Mike. Now you've got $900,000. The first building you had $300,000 in depreciation. Second building you've got $900,000 in depreciation because you just rolled it over. You got $900,000 coming back to you in tax credits. You can't use all that in 1 year, right? So you're rolling that into next year or the year after. I mean, you can take that out. How many years, Larry?
You can carry that forward indefinitely. It used to be a cap on those carry forwards at 20 years. Now you can carry them forward indefinitely.
So you can do that now. And if you were, let's say you were at 55 and you're doing this right up until you want to retire, and then you can take all of that retirement income in your golden years at zero taxes because you have that income out there. And so now when this rental income's coming in, but it's an amazing strategy to allow you to compound that and to maximize your cash flow and your capital without Uncle Sam getting involved and taking 30% of the pie every single time you try and do some sort of a transaction. It's
so
magic.
good.
It's literally magic.
It's so good. So let's shift this, and I know Shannon's going to be excited about this.
Come on.
So Larry, how is crypto? Okay, how is crypto affecting all of this tax stuff?
Folks are running wild with crypto, and it presents a lot of opportunity. The way that crypto is currently treated from a tax perspective, it's treated like property. So if you sell it, right, Then you have capital gains, which we know is more favorable than your ordinary income. So that's one. But if you don't sell it, there are opportunities to leverage against it, right? When done appropriately. So just as Shannon used that example of capturing the equity and the upside, you can leverage against your crypto to pull debt out. And now you've still got your holdings, yet now you've got access to liquidity and cash to go hopefully get more investments that outperform whatever interest rate you're paying back. That could be really, really good on the crypto side. And then there's actually a court case that, it hasn't provided any precedents just yet, but it's interesting to see where the direction is headed, because when you get into the staking side of crypto, there's this contention about when do you pay taxes? And as it stands, you're supposed to pay taxes when that coin is mined, right? When you have a receipt of it. But there are some challenges out there of not having to pay taxes until you actually do something with that coin. Now, it remains to be seen where that goes, but the opportunities are endless. Crypto presents a very unique opportunity for a huge wealth jump for a lot of folks, but also some amazing tax strategies and tax plays for folks as well.
So here's one that we've seen a couple of our investors have done in the last year. They saw massive gains in 2020 in their crypto holdings. They sold those crypto holdings. They moved that, because then they were able to take it as capital gains. They moved that into opportunity zone funds. So then they invested in real estate deals in an opportunity zone fund. And the opportunity zone fund defers that taxes, Mike, until 2026, fiscal year 2027. You don't have to pay the taxes on it until then. And then if you leave it invested in that particular asset until 2030,
well, at least 10 years.
10 years. So if you invested in 21 till 2031, if you leave it in there, when you sell out of an opportunity zone after 10 years of investment, you pay zero capital gains, man. So now you're able to take your crypto, and if you could make just a measly 8% on it from the time you sell it, you can pay your tax bill with it, because you haven't sliced it up, and you've got the time to generate that tax revenue to pay in 2027, fiscal year 2027, tax year 2026, right? The other thing, Larry, to add on to what you're saying is, like, if you go to crypto.com and you buy or you stake there with their process, they pay you in their coin, that crypto.com coin. They're trying to get that declared as a reward, like when you swipe your Sparks card or your Capital One or whatever, and they're giving you all these rewards tokens. That's what they're trying to say these are, for layman's terms, that these rewards tokens are yours. So if you're getting those now where crypto.com is at 45 cents and you hold on to those for 10 or 15 years till crypto.com is $45, you've created massive wealth through the use of a debit card and a reward point that would give you massive amounts moving down the road. So there's a lot of interactions there. I buy a lot of my real estate stuff with my crypto.com card. I use my high interest checking accounts in my crypto.com for my real estate. So when I'm moving funds back and forth, I'm getting 10% interest on it from crypto.com. I mean, there's all kinds of ways that these integrate. And then you've got the preferential treatment of capital gains on it when you do get hit with it.
Yeah,
it's freaking amazing.
Also,
I did get excited.
I knew you would.
Depending on how you hold it, right? If you're holding and your plan isn't to need that money right away, if you hold it inside of a vehicle like a Roth IRA, grows tax-free over time, comes out tax-free. That could be an amazing strategy as well. Because imagine that long runway, and then when you hit the retirement age, whatever it's grown to, you get to take out without any tax implications at all. That's pretty powerful.
That is good.
Oh, man.
That's
I
not
told you
even
he knew what he was talking about.
I believe you now. I'm just kidding.
I hear that a lot.
Good stuff. Good stuff. Well, I mean, I can't help but come back to this idea of tokenizing that property that we originally were talking about, tokenizing that, and then borrowing, like you were saying, taking that money from the crypto. It just, I mean, this is just crazy. I get excited about it, but it's like, and I'm actually going to rewatch this a few times. And I hope you guys that are watching, you're taking notes and you're sitting here, getting ready to reach out to Larry, go check him out. Larry, how can everybody keep up with everything you have going on?
Yeah, appreciate that, man. Well, first place they can go is our website, which is pb-strategies.com. And Shannon likes to call it peanut butter, right? But pb-strategies.com. And there's a big discovery call button as soon as you hit the website. And we can sit down and have a conversation just to learn a little bit more about you. But all social media channels, they can follow us at Precision Business Strategies. We're always putting out content and different ideas and strategies for folks to consider.
That's great.
The other thing too, Mike, when you start to look at it, I mean, it's important to realize that blockchain technology is one of the major innovators that we're seeing in the world today, because it allows us to fractionalize and transfer those assets and that security in a way that we've never been able to do before, and in a way that even the IRS and the SEC is looking at and going, hey, that's property. That is in a way that anytime you can get it from ordinary income, okay, to property or to something that is in a capital gains category, you're talking about a much better tax bracket. And so you're going to see, just like you've mentioned with tokenizing real estate, tokenizing cars, tokenizing airplanes, right? Jet token just came out. There's all this stuff that where you're actually able to see the physical reality of what tokenization does in the exchange of information all the way around the world with what's happening and how that is coming together to where we're using smart contracts to convey ownership in a way that's recognized by the IRS as an asset and as a physical asset, not some sort of intellectual property or not a job or anything like that. So your funds that you're making off of that are taxed at a whole new level. And that's going to be something to continue to follow with some of the court cases like Larry was talking about, because they're deciding this on a weekly basis. They're going through this and deciding what's really going to happen and how it's going to come out.
Yep.
That is crazy. So what I'd love to do, kind of wrapping things up here, is what can our listeners, people who are watching this Mighty Roundtable, this is just so fun, man. We got to do these more often, honestly. Yeah. But what can we do? Let's start off each person here. Let's go through and what can people do to stay involved and maybe to get started right away?
Go ahead, Larry.
With regard to tax planning, you mean?
Yeah, of course. That's your realm, and definitely we'll go back to real estate, crypto, and all that with Shannon.
Mm-hmm. Yeah. I think there are a couple of things to do. One is, as Shannon was mentioning, understand that the transition towards using that money that you're earning to buy assets is going to be 101 for starting to build a massive amount of wealth and build wealth in a tax efficient way. So that's going to be number one, is to transition to owning assets and understanding how to leverage them to get tax efficiency. The second thing is focus on planning. Before you execute any transaction out there, sit down and talk to your person to figure out what that means for you. Because at the moment that you get that LOI, that you sign the LOI, that you execute the transaction, your strategies start to shrink and there are limited opportunities. But if we can get involved early enough, I think there are tons of things that we can do to help you save on taxes.
Super exciting.
And I'm going to echo what Larry said, because, everybody thinks that, well, I don't know, I can't, I'm not big enough, I'm not this, but it's these little strategies. I mean, think about this, Mike. If you've got $10,000 a year to invest, okay, that seems like a lot of money. That's about $800 a month. But if you have to give 37% of that to Uncle Sam every year, because you're not doing your investments in a tax strategic way, you're giving up $3,700, $37,000 in 10 years, and over 140 grand of investment power over the 40-year life. And that's not at a compounding rate. So Get involved with talking about, follow Larry, follow what he's doing. You can implement a lot of this. I heard somebody say there's no need to go to college anymore. Everything you need to know is on YouTube. That particular gentleman's name was Elon Musk. I think he knows a few things. I don't know that I totally agree with that, but I've learned everything I know by reading it and doing it myself and surrounding myself with professionals like Larry. But if you just look at it from wherever you start, looking at being strategic in your tax savings, that $3,700 a year turns into $37,000 a year as you grow and as you get bigger and your income gets bigger, and you don't have to relearn those habits. You're just slowly adding to it instead of getting to the point where you're now making $500,000 a year. You talk to somebody like Larry and he opens your eyes, and one person is sitting there going, oh my God, I'm so glad I met you. And the other person is throwing up in the parking lot because they're sick about all the taxes they've lost over the last 8 years because they didn't do it sooner. So get involved early. Take the time to learn and get started on this journey of understanding how to be tax efficient. It's the best thing I've ever done in my business building.
Yeah, what's the loss? What is the opportunity lost by not getting started at the very lowest amounts, like you were talking about? At any level, you should be able to get started, right?
It's amazing what you can do. Yeah, I mean, if you really think about it, I just did a deal, Mike, that we had under contract. It took us 9 months to get done. I'll just put this in perspective because you want to know about loss. I just put this deal under contract. We just closed on it. We're going to put 60 units of apartments on there, and my earnest money on tying this up and getting it all entitled was $25,000. So that was 1 year of tax savings on $100,000 income, right? If I can get that to a zero tax strategy, that's 1 year. And on that one deal, I will make over $1 million. So how do you say that you can't take the time to be strategic in how you plan? Because that $125,000 earnest money put me in a position to multiply that over the next 3 years into a full-blown project that had I not had the tax strategies in place, I wouldn't have been able to take down the deal. So tax strategies literally saved me 25 grand, made me $1 million.
Jeez, there you go. That's going to be the tagline. I'm going to change the tagline. 25 to 1 million with tax strategies.
Right.
Good stuff.
Yeah, I mean, that's just, those are some of the things that you can do. And then being able to implement that with, putting that together with your real estate purchases and plays and all that.
Well, Larry, I'm definitely going to reach out to you. And of course, Shannon, it's always a pleasure to hang out with you. You bring the best guests with you. And so we're going to give major kudos to Shannon for his network. And you guys go out there and build your network so you can build a mighty net worth. And guys, tell us if there's a guest that that we just have to have on the Mighty Roundtable. Yeah. We do them once a month. Me and Shannon are just having a good time learning and growing and building our network. And Larry, I appreciate you taking the time, brother.
Thank you. Appreciate the opportunity.
Always good to see you, Mike. Look forward to it next month.
All right, you guys, take care, be safe, and I don't know, go out there, get some beach, wear that cool watch. See you guys.
See ya.